Good morning, good afternoon. My name is Rob Britt, and I'm the Senior Vice President of Multifamily for Zonda Media. And I'm thrilled to be joining you for the second multifamily update of 2023. We have a ton of great new analysis to share with you today, so I'm going to get right to it with a few housekeeping items up front. First and foremost, I wanted to thank our two sponsors who are responsible for bringing you this great insight, Assurant and Sunnova. Assurant is a global provider of lifestyle and housing solutions that help leading brands grow revenue, manage risk, and deliver a great experience for residents. Assurant has been dedicated to multifamily housing for over 30 years, supporting over 2.5 million residents and partnering with more than half of the top 50 property management companies as published by the NMHC. Assurant is with you through the entire resident life cycle before, during, and after the lease, with a suite of programs that help mitigate risk, increase revenue, decrease bad debt, and increase occupancy. They create customizable solutions that increase your profit, protect your communities, and streamline your operations, freeing you and your team to focus on maximizing occupancy and caring for your communities. And I also want to thank Sunnova. Sunnova is a leading national residential solar and energy storage provider with a specialized team dedicated to the home building industry. Their experience in the new home sector means Sunnova understands the complexities of home building and offers customized solutions to help you build homes that homebuyers want. With over 50 partners across the country, Sunnova was founded to deliver customers a better energy service at a better price. Through Sunnova's solar and solar plus energy storage service offerings, they are disrupting the traditional energy landscape and the way that the 21st century customer generates and consumes electricity. They are the exclusive distributor of Franklin's 208 voltage battery, and you can learn more about this product at a webinar that they're going to be hosting on September 20th. You can visit sunnova.com/208V to learn more and register. So while Zonda is a data provider with an extremely powerful team of experts, advisors, who are one of them you're going to meet here today, we also host many in-person events throughout the year. Since you're joining us for this multifamily update, we'd be remiss not to mention our next big in-person event, the MFE conference, which is being held in Dallas on September 26th to the 28th. You can find more information on this event at mfeconference.com. We'd be covering a wide range of themes from development to finance to operations and technology. And today's presenter, Kimberly Byrum, will be speaking in person in Dallas next month. Owner-developer attendees can use code KB20 to get 20% off their registration. Same goes for our newest event called Elevate, which will be held in December in Miami Beach. Developers, designers, and brokers of high-rises will gather, and they're going to be discussing what's driving housing decisions of the luxury consumer. Now, without further delay, I want to introduce our presenter, Kimberly Byrum, Managing Principal of Zonda Advisory. She's recognized as an expert in the fields of multifamily consumer research, rent positioning, and product design with a strong technical background in market, submarket selection, econometric modeling, and revenue management. She has a lot to cover here today, so I'm going to turn it over to her right now. Kimberly, welcome, and look forward to hearing more.
Thank you, Rob. And for those of you who have not worked with or met Rob Britt, he is an icon in our business and works behind the scenes to promote events and products and clients across the country, and just a great resource in terms of connecting people and products and our business. So please reach out to Rob if you have a moment. So I want to jump right in today. It's been a quiet summer, so we have some things to talk about. I want to cover some of the data points that we're watching at Zonda Advisory as it relates to how are our renters feeling, what are developers thinking, and what are the investors looking at today. So we'll be talking a little bit about that. Again, we always jump right into the national fundamentals and where those are headed. And probably where I'm spending a lot of time is talking about pipeline. Where is the pipeline? What markets? How is it impacting our rent projections and our current activity? And then finally, we're going to jump right into some of the most active submarkets and talk a little bit about absorption, how they're performing, and some of the top rent achievers in these marketplaces. So want to jump right in. I have a lot of data to cover. I'm not sure I will have time for questions and answers. So please feel free to email me or call me. I'm always available. I love to visit about the data. So I like to start with where we are. And I was moderating a panel a few months back in Colorado, and I heard a very interesting term. I heard the term optically negative leverage, which kind of made me laugh to myself, because isn't negative leverage just negative leverage? Question mark. But overall, I think that kind of describes where we are right now. Obviously, I don't want to rehash a lot of what has been talked about ad nauseum, but we know the Fed funds rate topping out in that 5.25, 5.5 range, hopefully. How long will these rates hold before they're dropping? And a really important question that I actually look in the mirror and ask myself all the time, are we adapting to these higher interest rates? And if you'd asked me this question 20 days ago, I would have said, based on my business activity, probably not. But in the last 20 days, I've really seen an uptick in development activities and interest back into the market. And so I think my answer is potentially yes, we are adapting now to the higher rate environment. Overall, the labor market still holding steady, which is great for our fundamentals. Banks are kind of standing on the sidelines, adhering to those tighter lending standards. And obviously, as a result, the demand for multifamily loans has decreased. One of the big talking points is, how do we underwrite future rent growth? That's cooling overall. I don't think we see anybody projecting 4, 5, 6% rent growth that we actually have seen over the pandemic timeframe. And really important, and I'm going to present some data discussing this, is how are the supply chain issues compared to the concerns about pipeline? How is that impacting the pipeline? And how do we factor in the slippage that potentially is continuing to occur? And finally, we have been hearing this on the streets, but don't hold me to it. But we have heard that land prices are dropping somewhat. I think that the numbers that I have heard are within that 15% range. So overall, these are some of the talking points and the way that we're seeing the world as it stands today. On the right-hand side of the slide, I always like to look, I enjoy this conference board data about the consumer. The dark line is, here's where I think I am today. Here's how I feel about today, business conditions, my income, etc. And then the light blue line is how I feel about the future. Interestingly, if you look back at some of the big shocks in the marketplace, COVID, the great financial crisis, those are really the only times that we think the future is going to be better than today. So that's kind of an interesting phenomenon. But if you look at where we stand as of July, we actually have ticked up over that 80% range or 80 index. And per the conference board, anything above 80 is very positive, and anything below, there are more concerns about recession. So as you can see, the consumers are starting to feel a little bit more optimistic about future business conditions. They think they're going to be more favorable. Of course, again, they still feel pretty good about now. Probably the biggest nugget out of the July data was the fact that fewer consumers expect their incomes to increase. And I think this is really important as it relates to our residents, because they have seen such strong income growth during the pandemic. And I think that this will have implications. So how are the banks tightening, and how can we quantify this? And obviously, a lot of us look at the Senior Loan Officers Originations Survey. And so what the chart is illustrating is the period between 2015 and 2020, and the percent of banks that were surveyed that said that they were tightening their standards for multifamily loans. So you can see during that time period, we were operating at 16% of banks saying that they were operating at a tighter underwriting. When the pandemic hit, that basically doubled. So the conditions tightened, and you can see as we came out of the pandemic, there really became a free flow of multifamily loans, and we dropped down to the negative territory. And as we sit today, we are at a high of bank tightening for multifamily loans. And so how does that translate? Where does that translate? Most of the banks are saying that they've widened the spreads on their loan rates and they've lowered their loan to value ratios. Some of the banks have increased debt service coverage and decreased loan size, but overall you can see a moderate amount have done other things. But we are seeing that we're sitting at a point where the banks have really been standing on the sidelines for the interim. We continue to watch this, but this is a great data point to keep in mind. Delinquencies. CRE delinquencies are getting a lot of press time in the Wall Street Journal and on all the online clickbait because the data suggests that there is over $980 billion in multifamily debt set to come due in the 2023 to 2027 period. So we're watching that. Obviously, a lot of that free-flowing debt days that we saw after the pandemic began to open up, a lot of those loans were taken out at adjustable rates. Those are the ones that we consider more high risk, obviously. We have, and this chart is showing us, if you open this chart up to a 5-year period, you would see that we're still at a very, very low rate of delinquency for commercial real estate loans. But I wanted to tighten it so you could see that there has, in fact, been a slight uptick since the third quarter of 2022. And we'll continue to watch that. Overall, this is commercial real estate loans. CMBS delinquencies for multifamily are still below 2% as of June. Haven't seen the July data come out yet. However, if you compare this to office, they are actually at 4.5% delinquency. So that, again, the office is really driving a lot of that CMBS delinquency at this time. Overall, if you look at other types of loans, Fannie Mae, you would see that those are all, under 0.5 percentage point. So a lot of the other life insurance companies, et cetera, all that data suggests there's very little delinquency currently in the market. Again, nowhere near what we saw during the great financial crisis days of 8 to 10% delinquencies. So the bond market. We've gotten really smart in real estate about the bond market as of late. Everybody seems to be watching that. So I wanted to share just some of the stats. Obviously, we've been operating in an inverted yield curve since July of last year, and nothing's changed there. We continue to watch that, but that's typically associated with predicting recessions. I think when you survey some people in our industry, we currently think that we are in a CRE recession for sure. On the other side, you look at the high-grade corporate bonds versus the 10-year Treasury. Again, this is kind of a game of inches and basis points. Prior to the Fed tightening, we were running at about 240 basis points over the 10-year for a high-grade corporate bond, and today that's down to 209 basis points. Again, when we look at these things, we're trying to read the tea leaves, see where the market's going, and it's just really hard to interpret. And it really kind of leaves you in this neutral standpoint. And I think that that's what we've seen throughout the summer is a real neutral standpoint in terms of investment, in terms of deal flow, in terms of new projects coming into the underwriting. So finally, and I like to watch this, and I think this is actually a really eye-opening weekly survey into the investor's mind. And this is the American Association of Individual Investors. And what they do is they survey their members every week on how they feel about the direction of the stock market. And so if you look at the buildup, and last week it was 816, and people kind of pulled back a little bit last week, but prior to that, throughout the summer, people were very positive about the stock market. But if you compare that to the historical view, you can see that the bears are right kind of where they are historically in the market. And what's interesting is that the neutrals are kind of bigger right now. So those are the people that are kind of standing on the sidelines, trying to figure out where things are going. And, we are starting to see that churn and see people jump back in the market. So I thought this was a really interesting way to view what's going on in the market today in terms of investing in commercial real estate. So quickly flipping over into the national fundamentals. And this is a chart that I always share. Again, this is a courtesy of RealPage data. We are through the second quarter. As I mentioned, it's been a sleepy summer. Occupancies have dropped slightly from the first quarter, but are still above 94.5%. If you look at the national data, we have not seen the rent numbers tick down, but if you do go and look market by market, we are starting to see that reset, and I'll share that with you in a minute. But in terms of occupancy overall, we have seen the southern and western regions have larger drops in occupancy, which is where most of the product is obviously entering the market, and that's not unexpected. And then finally, we will continue to see that resetting of rents as we go through 2024 and 2025. So how does that translate into occupancy by floor plan? And I wanted to share this, and I wanted, while the vertical axis, I want to point out, it is very basis points difference in occupancy by. So throughout my career, 1 and 2 bedrooms pretty much perform in lockstep with one another, and we've seen in occupancy, you can see that kind of fall through, but really, 94.7, 94.8, 1 bedrooms and 2 bedrooms remain similarly occupied. The biggest mover has been the 3 bedrooms, and remember, the 3 bedrooms gained a lot of favor during the pandemic because people were searching for more space, working from home, and so we really saw an increase in the demand for the 3 bedroom units. That has come back down. One of my theories for that is obviously people may be moving into the BTR space where they are offering more 3s and 4 bedrooms than we do traditionally in the higher density product. And so I think that may be having some impact on 3 bedrooms. And then the studio apartments, which were the least favored, people were moving out of those, out of the urban areas, and then also out of smaller units to get more space. And so that has also declined at the same rate as the 3 bedrooms. But overall, again, want to make a very important point that this is less than 1 percentage point difference. So don't come away from this thinking, oh, I never want to do a 3 bedroom again. I'm just showing you the movement amongst those. So how are renewals doing? Overall, we're still remaining higher than that historical 51% on renewals. Again, not surprising with mortgage rates where they are today. If you look at the REIT report, the people that typically go out and buy homes, so we're just a little bit above that. I would expect that to eventually go back down to 51%. But again, we're topping in that 53%. Overlay that with what we saw consumers thinking about their incomes. And I think we're going to continue to kind of ride that mid 53, 55% range because people are going to stay put for a while. Now, as new product is entering the market, they may go and opt to get a newer apartment, but I really don't see the renewal rates falling off a cliff here. And again, for an existing owner, this is a great opportunity to manage your renewals and take advantage of this time period when we think people may be staying put longer because they just don't have that out. So traffic, how is traffic doing? If you recall from my webinar that I did in May, I predicted that the second quarter traffic, it should be between 10 and 15% up from the first quarter, kind of going back to the seasonality that we saw pre-pandemic, and we were right on the money at 10% of an increase. So that's great. Going forward, again, we're moving into the slower leasing periods in the third quarter and the fourth quarter. So now I'm predicting that we should see a decline in traffic going down 13%. So all that to say, not necessarily a need to panic when you see your traffic go down. That is back to that normal seasonality that we would typically see. Stabilized concessions, still watching these. I constantly bang this pot to say this is a great indicator of market health. And as we go in and update comparables, that is one of the most important things that we're looking at on a very micro market basis is, does a property that is in lease up offering a concession, are they able to burn that concession off once they become stabilized? And for the most part, we're definitely seeing that. The stabilized concessions are have remained low. You can see that they are very much like a switch on and off. And even during the pandemic, they popped up a little bit and we've come back down. So continue to watch that. I can't preach enough about how this is such a great leading indicator of where the markets are going. So switching gears a little bit, I have a lot of people asking about the impacts of the supply chain on our construction timeframes. You know, what's been going on over time in getting product to market, and certainly during the pandemic period, and what we've continued to see bleed over into different availability of appliances, windows, electrical panels. I've heard all kinds of different metrics and horror stories about availability of product and getting product to the market. So I've taken the government data from the census and I've indexed it to 2019. And from that point, I have calculated the number of days of increase in the construction schedule since that time period. And just keep in mind that, you know, this government data always illustrates that construction timeframes are increasing. I think what's really interesting, and it definitely follows the pattern that we would expect to see from a reasonableness standpoint during the pandemic. And so you can see, so starting at a baseline of 2019, between 2019 and 2020, the time from start to finish of a multifamily deal increased by 12 days. And that's probably a pretty normal span, just rain, weather patterns, et cetera, project size, project type, product type. If you go from 2020 to 2021, you see that we added a month to our schedule. And again, that is definitely, I would say, attributed to the slippage occurring because of the supply chain issues. From 2021 to 22, another 15 days added to the schedule. So at this point, we're sitting in 2022, and I would say that we would basically see a lot of the product under construction slipping another quarter to completion. So where are we going in 2023? If you continue that same trend, that forecast would lead you to about 15 more days, which is 3.5 months. If you got aggressive and you were still negative on what was going on in the market, you might add 24 days, which would get you to almost a 4-month lag in terms of, you know, measuring starting in 2019 to today. So overall, we use these slippage calculations when we're looking at product under construction to help us understand when we think the product's actually going to hit the market. And so how does that translate into our forecasts? Kind of flipping over into our actual deliveries in the dark purple, and then the forecasts, assuming the slippage going forward. You see that 2023, we're predicting about 350,000 units to hit the market. In 2024, that is going to be a big pipeline year. We're all looking at it. We're all anticipating it. And we're seeing that. We'll think that will hit a little above 400,000. Keep in mind, 400,000 has always been that metric that we need that amount of housing to be delivered every year in order to keep our housing markets in balance. So that's good. Once we hit 2025, we're definitely going to see a pretty big chunk of units hit the market. 450,000 are almost hitting that number. So a little over our skis potentially, but then a giant drop off. And again, this is analyzing just projects that are currently under construction and applying slippage. So there may be some planned ones that slip in, but that 2025 to 2026 drop off is equal to about 66% of a decline in pipeline. And then 2027 goes to even lower than that. I would say that we're starting to see activity ramp up somewhat. So 2027 might be maybe up above 200,000, just depending on what happens in the third and fourth quarters. But overall, we're working right now on late 26, early 27 new projects. And so, you know, the pipeline is definitely emptying out in those time periods. So I'm going to stay on this slide for a minute because it's a lot of information. And so if you want to take a picture of it, we're also going to provide these slides if you want a copy of them. But overall, so what I did here methodology wise was I took the top 30 markets that we work in and I applied sorry. I applied my slippage calculations out through 2026. And then I compared it to that typical rule of thumb, percent of existing stock over the 3-year average. And so I've put the markets into buckets. And so the good news is that the low pipeline markets, it's a really long list. The bad news is it's pretty much every market that you would expect already needs housing and isn't building enough, with a few surprises. Charlotte falling in there in the Southwest, Jacksonville is also in there, and then Houston, which kind of migrates back and forth from low to high pipelines pretty quickly, but currently is kind of a laggard in terms of new construction. So, but on the high pipeline side, there are really 4 markets that I would say are on the watch list, so to speak. And Austin, interestingly, being number 2, by my calculations, will have run through their peak pipeline by 2024. So that's good news for Austin in that we're staring at a drop. It's dropping from 2024 to 25, and then it's dropping again another 60%. So overall, we're going to work through a lot of that pipeline over the next 2 years in Austin. Orlando and Denver, just technically fall over 3, but really aren't that far over 3. So I could put them in the balanced area as well. And again, good news for Orlando is they're hitting the majority of their pipeline now and will be starting to fall in 2024. Same thing with Fort Worth and Richmond. And again, Charlotte was another one that is falling pretty dramatically after 2023. In the balanced category, Dallas and Fort Worth, I always look at those 2 markets very differently. And you can see that Dallas, always a strong market for growth has stayed pretty under the radar during the pandemic. We really didn't crank up our new construction beyond our skis. So that was good news there. So there was some constraint in the markets. And then overall, you can see most of the Florida markets kind of in that balanced category as well. Miami on the low pipeline side. So this is one of my favorite ways to analyze a lot of different markets. And so bear with me for a minute. Occupancy currently as of 2Q on the horizontal axis, and year-over-year rent growth as of 2Q 23 on the vertical axis. So the national average rent growth, 2%, and national average occupancy in the green line, 93.5. And then I have a dotted red line just to show you where positive rent growth versus negative rent growth. And so you'll see the majority of the high active markets that we work in are still above the national occupancy 93, or looking at that 93.5 as the main occupancy. Occupancy is actually 94.5 there. And you can see also that the markets that I identified as higher pipeline markets, 2 of those are actually below and resetting on rents, but some of them are also positive. And so we have a lot of really strong markets that are still remaining rather strong, even in light of pipeline that is there, that is currently in lease up. And so again, I think what you're hearing and what you're reading is that the fundamentals are pretty strong, and it's just really more of a crisis of interest rates and deal flow. And that's definitely what's playing out in the second quarter data. So I'm going to jump now into some of the active submarkets, since I know a lot of you on the phone call are from Texas and Florida and California. So I want to drill down and kind of talk about some of the markets that you might be the most interested in. So first off, what the methodology that I employed was I took every submarket or every market that we're active in. So those 30 markets that I illustrated previously, I applied the slippage calculations, and then I sorted them from most pipeline to least pipeline. And so first of all, before showing you the top 20 pipeline submarkets as measured by that total number of deliveries, I wanted to show you what metros have the most submarkets in the top 20. So no surprise, Austin, again, being at the top of that market, and just has a very diverse pipeline. It's dispersed throughout the metro areas, primarily on the east side, but lots of different submarkets, north and south, has 4 submarkets that are within that high pipeline submarket. Charlotte has 3 submarkets on that top 20, and then Dallas has 2, and you can see that list goes down to 1 submarket on the top 20. So what are the characteristics of the submarkets that hit the top 20? The majority of them are suburban, about 55%, compared to 45% urban submarkets. So I'm going to go ahead and share with you the top 20 pipeline submarkets, and just to kind of roll through these to give you a sense. Of course, number 1 is Phoenix, that Avondale, Goodyear, West Valley area, followed closely by Central Nashville. And then you have Allen, McKinney, and Frisco. And that's all that northern quadrant of the Metroplex that's seen a tremendous growth. East Austin, as I mentioned, and Round Rock, both on the east side of Austin. Southwest Charlotte, and then Mid Wilshire in LA pops up in the middle of this chart. North Lakewood is in Denver, and then we've got Miami, North Charlotte, a couple of submarkets in Orlando, and then we have 1 Central Raleigh's got quite a bit going on where they're building up their downtown area. Cedar Park is also a northeastern, north central suburb of Austin, and then uptown South End is in Charlotte. So I wanted to take a few moments to review the pipeline and talk a little bit about what's going on in some of these top submarkets. So first off, Avondale, Goodyear, Glendale, the West Valley is a very large geography, and I'm examining all of the projects that are currently in lease up and how they're performing. So first of all, characteristics of the pipeline, almost 50%, a little over 50% of the projects in this particular market area are garden style. Many of them are 3-story walk-up, but we are starting to see some enclosed corridor projects out in this space. But again, you also have a very healthy BTR market out here, and very, very little podium or wrap. This is just not a podium wrap market yet. There is a few little mixed use in urban areas that are growing up around, but still very limited in terms of structured parking deals. So overall, the top developers, no surprise, are primarily BTR or horizontal apartment developers with the Cavan Company, Empire Group, Live, and then you have Alliance Residential and IDM also with quite a bit, over 1,000 units under construction. And this is actually units planned and under construction in these markets. From a lease-up perspective, we have seen a decline in the lease-up momentum in this submarket. We've gone from 20 move-ins a month to more like 13 move-ins a month. And what's interesting here, and we oftentimes see that the BTR has a slower absorption pace, and that's definitely playing out in this submarket. And one of the reasons for that is just the construction cycle. Many times they deliver and they absorb, they deliver and they absorb. They aren't building out a full 37 or 45 unit building and moving the whole thing in at once. And so their pace of absorption is just sometimes a little slower because they don't have as much product to absorb consecutively. So overall, that we do see that. The garden style in this submarket are offering a slightly higher concession, but keep in mind, even with the amount of units that are under construction, we still are just now right at about 1 month free in this submarket. The BTR is a little on the lower side at a little over a half a month. And that could be a half a month and, 1 month free of your amenity fee or your technology fee, something like that. So overall, again, those lease up concessions are a little under 1 month free. And then importantly too, the garden style deals in this submarket are averaging about 300 units compared to the BTR, which are a little under 200 units as a project size. So I wanted to highlight a few of the highest rents in this submarket. And so first of all, on the BTR side, you have Cyrene at Estrella, which is a curve development managed by Mark Taylor. It's a small single family home deal with 64 units, an average chunk rent or an average asking rent of $2,700, which is equating to about $2 a square foot. They are moving in, as I mentioned, at a slower pace. Again, I do believe that some of that has to do with the construction type, but 6 move-ins per month, currently sitting at 89% occupied and doing about a month free at this property. Conversely, the Glen 91 is a garden deal developed by HCW Development, managed by PBL, 296 unit deal, asking rents very close to $2 a square foot, $1.94, almost $1,700 in chunk rent, doing 16 move-ins a month, at currently about 39% occupied. And I would say at 39%, they may really start to improve that move-in, because a lot of times at that pace, you don't have all of your community amenities available yet and things like that. And so once you hit 50, I really call that a trend, but they're currently at the 16 move-ins per month stage, and also at that 1 month free. So some of the deals going on out in that Avondale area, check them out. Switching over to Nashville. Nashville is a very urban submarket. Also have a couple of, what I would call the major developers, Mill Creek Residential, Lincoln Property Company, as well as some of the more local regional developers. Overall, if the pipeline is primarily high-rise or podium, we even have almost a quarter of the projects at over 30 stories. So very, very exclusive, exquisite, luxury, high-rise projects entering into the market in the central Nashville area. Garden is on the very, very low side. Lease-up momentum, believe it or not, in central Nashville has actually improved from 14 move-ins a month to 20 move-ins a month. And I think that's really unique and important to point out, because we traditionally see high-rise buildings lease up slower, not because there's less demand, but because you have elevators and things like that you have to use to move in and out. So you can only do so many move-ins per weekend and things like that. So I think that's saying there's some strength in the market in terms of lease-ups. Overall, all of the product is doing about 20 units a month. So that's, again, very good news. The high-rise, and this is important to note, typically on higher rent deals, we will see higher concessions. And so that's definitely playing out in this market, where we're seeing 14% of the high-rise buildings offering a concession compared to the other product types at about 11%. Overall, the project sizes are rather large, 312 units for the high-rises and 248 for all of the other product types in the central Nashville market. In terms of deals to take a look at, Fallen is a 25-story high-rise currently in lease-up, 63% occupied by Greystar, 347 units, an average of almost $4 a square foot in asking rent, doing 13 move-ins a month with a 9.4% concession. Novel Edge Hill is a podium wrap deal in the Gulch, developed by Crescent, managed by Greystar, 270 unit deal, almost at $3 a square foot, $2,300 a month, doing about 10 move-ins per month. So overall, 85% occupied. They're probably at the very end of their lease up. So they've cranked up their concession a little bit in order to get over that hump. And so we're seeing about 11.5% concession there. Can't talk about pipeline markets without talking about Dallas. So I want to talk about Allen and McKinney. Frisco would be a little bit different. I'm skipping over that one for now, but Allen and McKinney also includes all of those newer areas out to the north, such as Anna, Prosper, all the way out in those areas. So this definitely encompasses a pretty large geography. Some of the top developers that have been active in these submarkets: Davis Development, Taylor Morrison, Trammell Crow, Next Metro, and Watermark. But overall, nowhere near the number of units at each of those developers that you would see in some of those other submarkets. Lease-up momentum hasn't been much impacted over the last year, going from about 23 to 20 move-ins a month. BTR and Garden are absorbing at about the same rate. And just notably, if you look at the characteristics of the pipeline, very similar to what we were seeing in Avondale from a Garden and BTR perspective. But we do see more wrap in the Allen and McKinney submarkets, and that's just primarily where you're seeing little mixed use nodes starting to enter the market, we will see that wrap product hit and come into the markets there. Overall, BTR, unlike what we saw in Avondale, is doing a little bit of a higher concession. There are actually many more BTRs currently in lease up than there are garden right now. So the garden product is pretty limited. And then overall, much bigger project size than you would compare to what we were seeing in Phoenix. 255 units on the BTR side and 469 units on the other products. So notable projects to take a look at. Mansions of McKinney BTR deal developed by W3 Luxury Living, and the manager also self-managing 210 units, an average of $2,200 a month or $1.85 per square foot, a little bit of faster momentum than what we saw in Phoenix at 11 move-ins, 6.2% concession. Waterscape, giving them a shout out. We actually worked with the developer on this project. Dalcor Residential, 469 units delivering, asking rents of $2.18 with an average number of move-ins currently at 20 per month. Just as a note, our market study said that they would achieve $1.92. So very much overachieving what we were projecting at that time, and 35% occupancy with very limited concessions currently. And finally, we wouldn't talk about pipeline without talking about Austin. So I'm gonna finish here. East Austin being the biggest deliverer of units over the next 2 years. Interestingly, this market is really, it's got high-end product, and there is also some workforce housing. In fact, what's in lease up currently, and I'm calling workforce housing really and anything way below like a $1.80 per square foot, and we're seeing about 30% of the units in lease up in that particular pricing range. So a good mixture of high end and some middle income units. Lease up momentum in Austin has decreased pretty dramatically, in half, from 21 to 13 move-ins a month with the garden product. When I say garden in my chart here, that's primarily double loaded corridor and surface parked deals because it is more of an urban setting. So 46% garden, and then wrap and podium about the same. Very limited BTR, and we actually see some modular units, again, trying to address the affordability issues in the central Austin area, and that area which is seeing a lot of gentrification. Concessions, again, ramping back up from 6% to 9%. And we're seeing that project size averaging about 312 units. So what to go see the next time you're in Austin, in East Austin? The Amley branch product, developed and managed by Amley, 407 units, getting $3 a square foot asking rent, moving in at a pace of about 11 per month with a concession of about 11.5. And again, those higher rents, usually asking higher concessions. And then the Vaughn, which is managed by Greystar, 312 units, right at $1.99, $2 a foot, $1,800 a month, for moving in at a pace of about 13 move-ins per month, 42% occupied, and doing about a month free. So again, want to just reiterate, if you have questions or if there's a certain submarket that you're interested in, please call me and we can talk about it. Love to visit about some of these, very active submarkets and what we've been seeing. So finally, just wrapping up, Zonda, we still believe that occupancies are going to continue that decline. We're at 94.5. We see that going probably into the 93.5% range. Again, because as the pipeline starts to hit into the markets, and that's really in many markets, and certainly in the Southeast, more of a natural rate of occupancy for us. Renewals, I pointed out, those are going to remain slightly above average because we see those mortgage rates remaining high and consumers feeling less optimistic. So definitely opportunity there to close the back door on some of your churn. Stabilized concessions, that's my favorite thing to talk about. They're low, which is an indicator of market health. And lease up concessions are definitely back, but we aren't seeing them really above those typical levels. And again, I always go back to the worst markets that we've ever operated in lease up concessions have been, upwards of 3%. And we saw that in Houston after the oil bust, and we've seen it in San Francisco. So that's kind of your high water mark, is that 3 months off. It's very hard to burn off 3 months of rent. And finally, lease up pace is down from the pandemic levels, which is somewhat driven by the slippage and those supply chain issues. But want to also note right here, I have a lot of clients who will say to me, well, Kimberly, if I lower my rents, will I get faster lease pace? And my answer is no. And I think Austin was a great example of that. You were looking at the Vaughn compared to the Amley, and they were both leasing at about that same pace. My answer to that would be, if you want more leases, I recommend you hire more leasing associates to go out and be responsible for getting 5 leases a week. And so that's where I think you really improve your momentum, is adding those lease ups more employees.
Kimberly,
So I just want to, Rob, I know you want to plug this again, but I want to just reiterate, we're going to be there. It's going to be a great agenda. So go ahead, Rob.
I was just going to say a great job on the presentation, first and foremost. I love the data points that you brought in, that you're following on a weekly basis, from consumer expectations, increasing, to expectations of incomes decreasing, kind of the mixed messages there, but the very positive, I think, bullish sentiment overall, that you're seeing to the stock market sentiment, and tracking how that might overlap with what you're seeing in your business. One of the questions that came up in the Q&A, I was paying attention to your pipeline deliveries. So I wanted to see if, since you didn't cover the Los Angeles market, are you hearing anything about the writer's strike, and how that is that moving the needle in any of the markets or submarkets out there, or anything anecdotal about that?
We haven't seen, we just finished underwriting a project in Burbank, and we have not seen anything yet that would indicate that there's been a softening in that market. And that market is a pretty heavy pipeline market, as is Warner Center, as well as Long Beach. Haven't seen any indications that those markets are going sideways yet.
Okay, good to hear. Good to hear. And yeah, I love the project highlights as well. Those were outstanding. Kind of the anecdotal piece of those hot markets that you're looking at. But yeah, so want to just one more time remind everyone of MFE conference. Kimberly will be there speaking a month away now at the Omni Dallas Hotel in Dallas. And then Q4, we have our newest event, Elevate, which is going to be focused on the art of high-rise living. So use those discount codes, and we might even have, if you're still out there paying attention, send me a note, and I have a couple discount codes that I can share with you if you're a first timer. Couple new products to keep your eye on. Kimberly referenced the build to rent market, and how it's still vibrant in a lot of the submarkets out there. We have a product, Rental Housing Outlook, that's now available. So we're really focused on build to rent, single family rentals, and we're giving quarterly outlooks and looking longer term, and have our own build to rent project index. Other products that we have out there, this is a free product. It's brand new, market snapshots. So go onto the site, zondahome.com/market snapshot, and you can download some housing insights for some of the top markets out there. And then finally, if you haven't seen some of our new ad campaigns out there, consumer facing, Livable is our newest and biggest listing product out there. And I'd invite you to take a look at some of the new home listings. We're really focused on new construction, and again, it's free to list on Livable. And then we have some real interesting virtual attachments to that. So create your listing online, go to livable.com. And that's all I have for you. Thanks for joining us, and thank you, Kimberly, for the presentation. And we will have a recording. And as Kimberly mentioned, we'll get the slides out there as well. If you're interested, send her a note.
Thank you, Rob.